Recently, a bullish note by Macquarie said that HDFC Bank, an elephant, can definitely dance. This comes amid optimism that the management can double the balance sheet in 4 to 5 years and other triggers. So let's find out how the bank has performed over the past 5 years. My colleague Harsh joins in for more.
Well, yes. So, Ankita, the key piece here is with regard to how brokerages are really looking at HDFC Bank. In fact, within the Bank Nifty, HDFC Bank has the highest relative return, average return, which analysts on the street are expecting at 28%. So, can the elephant really dance? We've tried to break up the metrics of this one to try and first understand where loan growth will come from. 4 to 5 years is what HDFC Bank is expecting to double their book in. We've tried to combine both books of HDFC Limited and HDFC Bank over the last 5 years. HDFC Limited plus Bank has been able to grow at nearly 17%, while HDFC Bank has been able to grow at 20%, and HDFC Limited has grown at 12% CAGR over the last 5 years. Where will the growth come from? Well, fresh branches. What they are continuing to do is add branches, 1,500 odd branches to be added every year till FY26. They've already added 1,479 branches in FY23. It looks like they are well on course for that. The net interest margins are expected to dip from the current 4.3% margin to 3.8%, and that's the current guidance that they've given. Of course, a lower risk book means that there will be a margin depreciation, so expect that. But they've largely met guidance, most times over the last 5 years. With regard to OPEX, very efficient bank. They've been able to keep their OPEX ratios in check. Cost to income has been below the 40% mark, though it did rise a bit to 40% in this year due to the branches added, but expected to dip back to 37% by FY24 again and deteriorate from there. We're expecting to see ROAs therefore and profitability currently around the 1.8 to 2% band, expected to rise to 2.1%, which is probably best in class in any case. Let's look at valuations versus the 5-year average. Now, HDFC Bank's valuation versus 5-year average largely is lower because you have HDFC Limited as well, and we fully appreciate that. But let's look at all the others as well. You're seeing ICICI Bank, Kotak Bank also trade well below their 5-year averages, even though Kotak and HDFC Bank by far look the most attractive when it comes to comparing to their 5-year averages. So definitely a case there for HDFC Bank.
Absolutely, Harsh. Thanks for taking us through all those details then. And